Well, good afternoon, everyone. Thank you so much for joining the call today. We are extremely excited to get started with part four of our four-part wealth building series. Please note, for those of you who have not already seen parts one, two, and or part three, all of those are available for replay on our website at apriem.com. You can go to the education tab, and underneath the tab there, you will see educational webinars. And on that page, you can access the wealth building four-part series. As we get started, we have set aside about an hour total for the presentation today. 40 minutes of presentation time, followed up with about 20 minutes of Q&A. Note that today's Q&A session will be a little bit different than previous sessions, but it's kind of a surprise. I'll let you guys see what that's like when we get there. If you do have any questions along the way, you can submit them in the questions feature inside of your toolbar. Today's presentation will be recorded as well, and we will get that uploaded to apriem.com as soon as possible. I'd like to also remind you that there is a survey that will pop up at the end of the presentation. We would love to hear any of your feedback. We do take that into consideration, and we try to make changes on all future events that we have moving forward. If you can't do the survey directly after the webinar, you will receive an email that gives you a second opportunity to fill out the survey. With that, my name is Josh Garland. I will be your host and moderator today. I'm joined by Christopher Whitaker and Megan Schwab. Christopher is our lead financial planner here at Apriem. He's both a certified financial planner and an accredited investment fiduciary. He obtained his bachelor's degree from Point Loma University in San Diego, California, and his advanced credentials from Boston Institute of Finance. Before coming to Apriem, Chris worked at a high net worth planning firm where he was trained in each of the financial planning domains. Chris is married with two small children who happily take up all of his free time. At his side is Megan Schwab, who is an associate financial planner for Apriem Advisors. She graduated from Biola University in 2018 with a BS in accounting. Megan first got her start in the industry as an intern here at Apriem and officially joined the team in January of 2020. With that, I will go ahead and turn it over to you.
Thank you, everyone, for joining us today. And we're so grateful for the large turnout and all the feedback we've received from the series so far. Definitely very touched to hear stories about how, even though some of the series may not have applied to your situation specifically, but that it was so helpful to either share or maybe even frame conversations with loved ones, especially the younger generations. And I'm really excited for the finale of our series. And today we'll have some great content for everyone, regardless of age or level of wealth. And we'll be taking a deep dive into one of the greatest of all time. But before we do that, we want to again revisit the heart of why we put on this wealth building series in the first place. We are a multi-generational firm and provide an antidote for the problem of wealth not lasting. And so with that being said, I'm going to pass it over to Megan to share some shocking statistics with us one more time.
Thank you, Chris. So for those of you who have not joined us for the other episodes yet, these are our problem statements that we here at Apriem are trying to help solve. So the first is 90% of wealth is lost by the third generation. 48% of Americans have less than $10,000 saved for retirement. Bankruptcy rates soar for lottery winners 3 to 5 years after they've won. And finally, 27% of adults would need to borrow or sell something to pay for an unexpected expense of $400.
Always gets me every time. All right, thanks, Megan. So let's dive into the finale, which we call the GOAT, or the greatest of all time, is what that acronym is. And so our subject today will be walking through the life of Warren Buffett. And we're going to start from the very beginning and go through how he used the principles we've discussed throughout the series to go from zero to over $85 billion in net worth. And that even includes some very generous gifting over time, of course. But I wanted to start with a quote of his. Someone is sitting in the shade today because someone planted a tree a long time ago. So first of all, it's very fitting for the heart of this series that everyone listening is looking to preserve and grow their wealth to have positive, lasting impacts, not just on your family, obviously, but your friends, your community, and maybe even the world. And second of all, because of how it is a helpful reminder that exponential math is not intuitive, and standing back to marvel at how amazing things can turn out with consistent growth over time is incredibly helpful, and also it's a humbling exercise as well. And so let's hop into the first little section here, which we dubbed the Oracle of Omaha. And so obviously Warren Buffett, he embodies the teachings of this series. He's built up basically a almost mythical persona. And you can see we have some fun facts here to help set the stage for the presentation. So the first one is people donate millions each year just to have a 3-hour lunch with him. And so Megan's going to go into some of the details of how that came about. And but yes, it's more than $1 million per hour now, because the latest bid in was over $4 million. So it's a pretty crazy stat there. The next one is 99% of his net worth was gained after the age of 50. And so we're going to be laying out more specifics on how this is even possible. But it certainly shows how consistent compounding is truly staggering, given enough time to play out. And he certainly got the compound machine working in his favor far earlier than most, too, which, again, Megan will cover in a second here. The third one there is $1 invested at 22% for 90 years grows to $59 million. So those numbers, right, obviously, so he's 90, but his long-term average from when he was a boy is about 22% per year. That's his compounded average. And so he sustained that for a long time. He certainly experienced eye-popping fluctuations that most investors wouldn't even be able to or want to attempt to handle in order to achieve that kind of return. But zoomed out, it's definitely very impressive. The next one there is one of my favorites. He really does eat like a 6-year-old. It's not a joke. So his diet consists predominantly of fast food, at least 5 Cokes per day, steak, hash browns, and lots of Dairy Queen ice cream. So his witty comeback to a reporter who asked him why he does this was, I checked the actuarial tables, and the lowest death rate is among 6-year-olds. So I decided to eat like a 6-year-old. So that just kind of shows you he's got kind of a witty, sarcastic humor too. And then the last one is, we've talked about this throughout the series, but no matter how much you're making, it's really about how much you save. And so he kind of also embodies frugality in a couple of ways and kind of wears it as a badge of honor. And so he's certainly extremely frugal relative to his immense net worth, but he lives in the same house that he paid a little over $30,000 for in 1951. It's also, got a nice short commute to his main office there. So anyway, so we're excited to go through this, and his life is really full of interesting and really impressive stories. And Megan's going to kick us off with his family life and his early years.
Yeah, so before we jump into his early success in his early years, we thought it would be fun to give you a little bit of his family's background. So Buffett was born in 1930 in Omaha, Nebraska, and this is actually during the height of the Great Depression. And something else very interesting, and I think it really speaks volumes to who Buffett is as an investor and businessman, is that entrepreneurship ran in his family. His grandfather owned a grocery store, where you'll find out that Warren Buffett frequented, and he actually worked at growing up. And his father also owned a brokerage house called Buffett Falk & Company, and Buffett will end up working here after college, and growing up as a boy, he would spend many days here, just being around different investors. Since he was young, he had an affinity for statistics and probability. People often remember his ability to quickly calculate columns of numbers off the top of his head, and it's actually a trait that still impresses his colleagues today. His first business ventures included selling chewing gum, CocaCola bottles, magazines, and lemonade. When he was 6 years old, he would purchase a 6-pack of CocaCola from his grandfather's grocery store, and then he would resell each bottle for a nickel. So while all of his friends were, playing or reading cartoons, he was turning a 5-cent profit on every 6-pack of Coca-Cola he sold. And finally, his father, Howard Buffett, was elected to the first 4 terms in the U.S. Congress. And as a result, the Buffett family moved to Washington, D.C. and lived there for a while. All right, so we're going to jump in and kind of learn about what he did during his teenage years and his 20s. So you see some numbers here on the screen. I'll get back to those after we jump into his teenage years. So in 1941, Buffett made his very first stock purchase by purchasing 3 shares of Citi's Service Preferred stock, and this was actually an oil service company. And he had bought this for $38 a share, and his sister bought 3 shares as well. This is actually the first example of when he panic sold stock because shortly after he purchased it, the stock price fell to $27 a share and quickly rose back up to $40. And as soon as it rose back up to $40, Buffett and his sister sold all of their shares for fear that it would go back down again. And almost immediately after that, City Service Preferred rose up to over $200. So this kind of illustrates to Buffett the importance of patience and timing. Obviously, from this example, he showed patience in waiting for the stock price to come back up a bit before he sold. However, he didn't give it enough opportunity to grow. So this story really impacts the decisions he makes down the line, and ones we'll share with you later. In high school, Buffett kept working hard. He was delivering newspapers, selling golf balls and stamps, and he even detailed cars. And one story we were particularly fond of is he would wake up at 4:30 every morning to deliver the Washington Post. And on his paper route, he would challenge himself to find ways to serve the 5 buildings more efficiently. And while he was doing that and going on his route, he would track the houses along his bike ride that had magazine subscriptions, and he would note when they were expiring. So eventually, on the side of his paper route business, he started a magazine and calendar business where he would sell calendars and magazines to households who were in need of either new subscriptions or updated calendars. And then finally, on his first tax return, he actually got an income tax deduction of $35 for the use of his bike on the paper route. Let's see. Okay, and another investment he made was in 1944. He purchased a 40-acre farm with a tenant farmer for $1,200. So he was able to do this because he had actually started investing in his father's brokerage firm and had saved enough to eventually purchase this. And then of the many businesses that he did before the age of 20, this by far, in my opinion, is the most impressive. In 1945, he and his friend Don Danley purchased an old pinball machine with the intention of starting a business with that pinball machine. So Don's job was to fix up the old machine while Buffett handled negotiations with a barber by the name of Frank Errico. Buffett told Errico that he and Danley worked for Mr. Wilson at Wilson's coin-operated machine company because they didn't want Errico to find out that this was just a business started and run by 2 15-year-olds. So Frank eventually agreed to let Buffett and Danley set up the pinball machine in his barbershop for clients to use while they waited to get a haircut. And both parties agreed that they would split the profits from that pinball machine. So after the first night, Buffett and Danley made $4, and by the end of the first week, they had made $25, which was enough to buy another pinball machine. And that duo eventually had pinball machines set up in barbershops all over D.C., and they had sold the business a year later for just over $1,000. And I think the best part about all this is Frank Errico never found out that Mr. Wilson did not exist.
I have a fun fact on we went back the one about them selling golf balls. Mm-hmm. So those were actually used golf balls, and him and a buddy would sneak onto the golf courses late at night with a snorkel and goggles, and they would dive into the lakes, and they would go down and they would basically take all of the golf balls that had gone into the lake, gather them all up, and then go back to the golf courses and sell them to the driving ranges, the used golf balls.
Wow. Very resourceful. Yeah, very impressive. He definitely started a lot of businesses at a very young age. But he had eventually he enrolled into the Wharton Business School in 1947 to continue furthering that passion he had for business and investing. But he dropped out in 1949 and transferred back to the University of Nebraska, where he eventually graduated. And after that, he wanted to get his master's, and he was rejected by Harvard Business School. But then out of that came an opportunity for him to apply at Columbia University and study under Benjamin Graham, who later becomes a really key mentor in Buffett's life. But Warren Buffett was prompted to apply to Columbia because he had read Graham's book called The Intelligent Investor. And after reading that, he was so inspired that he wanted to learn directly from Benjamin Graham and was given that opportunity. So Warren eventually graduated from Columbia University in 1951 with a Master of Science in Economics. So if we go back to this screen you see now, by the end of college, Buffett had accumulated over $9,800. So that's $105,000 in today's dollars. So while going to school and getting his master's, he had still managed to save all of that money he had worked so hard for, starting when he was 6 years old. So if we go into his post-college life, Buffett went to work for his father's brokerage house, again, Buffett, Falk & Company. He had desperately wanted to work for Benjamin Graham right after college and even offered to work there for free. But Graham told him no because it was too expensive to work for free. So he was teaching Buffett a lesson in the value of money, even after he had graduated school. So Buffett wasn't discouraged by that answer of no. He continued to bug Benjamin Graham and send him different stock ticks he found. And eventually, after all of that, Benjamin Graham was persuaded to hire Warren Buffett. And they had, a great working relationship. And through working for Benjamin Graham, Buffett had realized that they had some different ideas about what it was like to invest in a good company. So Graham was really focused on the company's financials and nothing else when deciding to invest. But Buffett had also looked at the company's management style and leadership. And something that Buffett said that really kind of backs up this point and drives it home is when you have able managers of high character running businesses about which they are passionate, you can have a dozen or more reporting to you and still have time for an afternoon nap. Conversely, if you have even one person reporting to you who is deceitful, inept, or uninterested, you will find yourself with more than you can handle. So he definitely takes that to heart when looking at companies, that he wants to invest in or buy. When Buffett was 26, he started his first partnership. He and 7 limited partners created Buffett Associates, and by the end of that first year, they were managing about $300,000. And by 1962, the partnership had capital in excess of $7.2 million. And $1 million of those dollars were actually Buffett's stake in the partnership. So he had reached his childhood goal of making or having $1 million by the age of 30.
Very cool. All right, and then I'm going to talk through his 30s and 40s. And obviously in the 30s and 40s, there's some really meaningful people, businesses, and events that would obviously further catapult his wealth by quite a bit. But before we dive into that, I just want to point out a couple of things here. So on this first page, you're seeing by age 40, he was worth $25 million. So Megan just said he was worth $1 million by 30. So he basically 25x'd his wealth from age 30 to 40, which is kind of a staggering statistic. So let's dive into how he actually did that. So if we go to, and so this is really where Berkshire Hathaway gets introduced to the conversation, and he's obviously very famous for it. Now, by the way, I'm going to use the Nebraska pronunciation of this. So Berkshire is that's how Buffett says it. I know some people say Berkshire. I'm going to say Berkshire, and go from him. So he still had his partnership in the beginning. So he was buying just normal common stock shares of Berkshire Hathaway in 62. And he was really just buying it because he felt like they were going through some hard times, and it was just a good deal, just like just like a normal position that he was eventually going to sell later for profit. But I love this story. So basically, what happened was he had agreed to a handshake deal with management of Berkshire at the time to sell all the shares that he had acquired for $11.50 per share. But when he got the official letter back from management, it read as $11.37. So that 13 cents per share difference made him so mad that he actually admits now in hindsight to throwing tons of money at Berkshire, just buying up every share he could to eventually gain control of the company and then fire the managers that messed with him for those 13 cents. So he really did it too, obviously. And so I think it's funny too. He does admit that this is probably the biggest investing mistake he ever made, ironically, because Berkshire Hathaway is I think it's the 8th largest company in the S&P right now. It's incredibly valuable. And yet it was one of his worst mistakes because he says that he calculated it out to be about a $200 billion mistake. Because if you count the opportunity lost because he had to pour so much capital into this bad business out of spite, if he would just have compounded it regularly at his long-term average, he would be a lot more wealthy. So in 65, he had finally accomplished the goal of taking control. He did shut down the partnership and threw out management and started working on Berkshire full time. And again, it was an obvious mistake because the business really was failing and not doing well. It was a bad buy. And so he quickly treated Berkshire as a holding company. And this is kind of where Berkshire starts to morph into this really cool structure to where he treated it as a holding company and then began to diversify out of the textile mill business. So he would basically like squeeze it like a lemon, trying to get every drop he possibly could in profit from the mill business, and then take that and diversify into other businesses that were quote unquote better businesses producing more capital. So he'd take all those retained earnings and started to kind of diversify his way out. So if we go back to the first tab here of this section, you can see, so he had a large dip in his 40s because he was trying to recover from how bad of an investment Berkshire really was. And he did diversify and buy enough good businesses to kind of wash that out. And so over that 10-year period, he was able to, a little more than double his wealth, but definitely not a 25x. So you can kind of see the mistake there.
Made for a great story, though.
Yeah, great story. Yeah, exactly. And before we go into his 40s, I just want to this is like the perfect highlight of how really what makes Buffett so special is you're going to see he makes a lot of mistakes throughout his career, but on average, he always finds ways to be efficient with capital on average and then keep it growing over time. So he just kind of keeps that snowball getting bigger and bigger and bigger. Okay, so let's jump into his 40s. And then on this one, this is where Charlie Munger kind of jumps into the picture. So for those that don't know, Charlie Munger is really his second, the member of the dynamic duo here. They were friends actually before Charlie Munger joined the board, but he officially joined the team, and he was a huge compliment to Buffett's style. Like Buffett very clearly recognizes that he wouldn't be nearly as successful without Munger's help, because basically what happened was, so Buffett was known for digging deep in the fundamentals. Megan kind of already covered that. So he was really taught by Ben Graham to look deep in the fundamentals, really kind of like rear view mirror driving. And then he would also look at management, so a little bit of qualitative. But then Munger kind of came into the picture and encouraged him to look at more qualitative factors and add those into his equations. And that's where there's a really famous quote that says, "It is better to buy a wonderful company at a fair price than a fair company at a wonderful price." And so that's a really subtle shift, but it's absolutely crucial to the success, especially as the capital base of the company grew to really large amounts, right? Because what that does, that small subtle shift starts to transition into buying some really key purchases throughout the rest of his career by being willing to pay up a little bit to buy a premium brand or premium company with superior earnings compared to its competitors. He really started to compound it at a fast rate. And so there's a couple of kind of classic examples here. One of them is Geico. Geico was very different when he started buying it back then. It was not nearly the animal that it is today, and they definitely didn't have as plenty of commercials. And so, but Geico started to really leverage the genius structure of Berkshire, because what started to happen was with an insurance company, you take in like as a customer, you pay premium, right? But then the insurance company doesn't immediately have to pay out. They pay out when something goes wrong, so they can hold capital and invest that capital for a period of time before, statistically speaking, they pay out on a claim. And so for a great investor like Buffett and Munger and the team at Berkshire, that was amazing because it gave them access to all this capital up front, and they were able to compound what's called float, all the float that they're getting in terms of the premium. And then in theory, they could make the premium payment, the outlays when a claim was filed basically free because they're able to grow that capital. And so the capital base started to rapidly expand with the help of insurance companies. And so that's one key example. And the second example is that this is kind of Munger coming in to pay up for a brand. So Steve's Candies has been around for obviously a very long time. They still own it. And at the time, they paid $25 million for the business, which was a huge cash outlay at the time. And it's just kind of a great example of paying up for the brand, because obviously they're delicious chocolates, but it's also just chocolate. But what people are buying is more due to the branding and what See's Candies brands really represents, right? And so, they've been able to kind of keep large margins for a long time. And then this, over many, many decades, basically, Buffett and Munger have received the value of that initial investment many times over. So it's just a good example of the introduction of moats into their philosophy.
Fun addition. You talk about Geico and being a very different business model way back in the day.
Yeah.
Right? And so today we can all get insurance through Geico. But, what Geico stands for?
I don't know.
Government Employees Insurance Company. Mm-hmm. It used to be strictly targeted towards government employees.
There you go. Amazing. I really do like their commercials. They're hilarious.
I know.
They are. All right. So now we're going to jump into Buffett's 50s and 60s. And his 50s are actually a very great time for him. He became a billionaire at the age of 56. So after all of that time, all of that investing and working hard, it had finally paid off. And he had his first $1 billion after Berkshire Hathaway actually sold Class A shares for the very first time. I think a fun fact to add in here is that he was still only making about a $50,000 salary. And at the time, the average salary in 1986 was about $30,000. So he wasn't even doubling the average salary. But his net worth was 5,000 times that of the average for 1986. So 1986, the average net worth was about $190,000. So you can see he wasn't making much more than the average, but he had thousands and thousands of times greater net worth than the average, all because of his savvy investing and just being a great businessman and really good at what he does. One of the biggest acquisitions during this time was his purchasing of CocaCola stock. So in 1988, he purchased so much of it that he eventually had 7% of the company in CocaCola stock. And that stock was hit really hard during the crash of 1987, which is what made it an attractive opportunity for Buffett, besides the fact that he already loved drinking Coca-Cola. And had those ties to it from selling it when he was a child. He had seen a great opportunity to purchase it, and Chris touched on this earlier. But this was also one of those purchases that kind of showed the change in Buffett's investment philosophy from buying a poor company at a fair price to buying a great company at a fair price. So at the time, Coca-Cola actually looked expensive compared to its past earnings, but Buffett was so interested in its future earnings potential that's what really sparked him to purchase it. So when he was kind of mulling over whether or not to purchase the company, him and Charlie Munger asked themselves the question, if they could increase the price of every Coca-Cola sold in the world by 1 cent, would they still have the same market share? And they figured that they could raise the price without losing market share because of Coca-Cola's strong moat. So their brand recognition, I know we talked about this a few episodes ago, but you can go almost anywhere in the world and order a Coke and people will know what you're talking about. They had a strong distributor network and they also have great retail relationships. So that's really what drove them to purchase this company. And they also figured that if they could raise the price by 1 cent per unit sold, the company's pre-tax earnings would increase by $2 billion. So it's a seemingly small increase for a huge payoff in the end. And Warren Buffett actually kind of gave a little history lesson in his explanation of why he figured this was a good idea. So he said when the Candler family bought the Coca-Cola company from the Pembertons in around 1905, the Candler family paid $2,000. And if the Pemberton family had reserved a penny a serving or a royalty a serving of a Coca-Cola bottle, the company would be sending a $2 billion check to the Pemberton family every year, and you wouldn't even see the difference in the figures. It's there. So they were right. The margins they projected would lead to a significant amount of cash back to them in the form of dividends. So Buffett and Munger are now receiving an effective yield of more than 100%. And, getting back all the money into Coca-Cola and more every single year. And a fun fact, this is actually the stock that Berkshire Hathaway has held for the longest time. And Buffett famously said if he eats 2,700 calories a day, a quarter of that is in Coca-Cola.
Cherry Coke, right?
Yeah. All right, and now we're going to head into his 60s. So there were a lot of several purchases and acquisitions that happened during this time. I'm just going to talk about two of them, but there were so many that happened. And I really like these two examples because they show that he didn't always purchase companies that it's had a rosy beginning right away. Some of them struggled when he bought them. Some of them struggled, years after he had purchased them, but he made it work. So Warren Buffett had purchased 12% of Salomon Incorporated, and this company at the time was a large investment bank that was headquartered in New York. It was actually one of the 5 largest banking enterprises in the United States and the most profitable firm on Wall Street back in the 80s and 90s. So after he had purchased 12% of the company, news came out in 1991 that a trader had submitted bids that were in excess of Treasury rules, and the CEO at the time didn't discipline that individual. So that, led to many lawsuits, and it had turned out that one of the traders for Salomon, Paul Moser, had in fact been submitting false bids in an effort to purchase more Treasury bonds than allowed by one buyer, and he had been doing this for if I remember correctly, it was from December 1990 to May of 1991. And one of the punishments as a result was a fine of almost $200 million to Salomon. And there was a chance that the company would be banned from bidding on government bond auctions. And that move would have crippled the company. But Warren Buffett actually stepped in and he convinced the Treasury Department to reverse that ban. So Salomon could keep bidding in government bond auctions. And he really helped out the company in a big way. He had stepped in to run the bank for a period of time until it was bought out by Travelers Insurance, which I'm sure you all are familiar with. And once that acquisition happened, Berkshire Hathaway saw its stake in Salomon more than double as a result of that. So it just shows that he worked really hard to make sure his investment was safe and taken care of, and he did everything he could to see that grow again. Another example is in 1998 when he acquired General Re. He actually bought it for $23.5 billion in stock. And almost immediately after he purchased it in the first quarter of 1999, General Re fell from $151 million to $151 million from $250 million, and that was due to significant underwriting losses. And then a few years later, after the 9/11 attacks, Buffett had realized that General Re had a huge error in the way that they looked at these insuring the companies. The possibility of terrorism-related losses wasn't accounted for when the company was setting prices and evaluating risks of the policies it sold. So because of that, in 2001, they had operating losses of $4.3 billion. So you could see he was probably feeling a bit defeated after those numbers came out. But something he had said was, should you find yourself in a chronically leaking boat, energy devoted to changing vessels is likely to be more productive than energy devoted to patching leaks. So he took this and he decided to use one of the executives at Berkshire, Ajit Jain, who had started working there in 1986. to take over as the head of General Re in 2016. So he had the former CEO step down. He got agent Jane in there, and Jane had really created an insurance business that was successful. He had created a business with a float of over $37 billion and a huge underwriting profit, and that's something that no CEO has ever come close to matching. And because of all that, Buffett had often praised Jane's character and business feats, which has sparked rumors that Jane may be the successor to the Berkshire Empire. And another funny quote by Buffett about Jane is, "If Charlie Munger, I, or Jane are ever in a sinking boat and you can only save one of us, swim to Jane." So he thinks very highly of his colleague. And finally, the last point I'm going to touch on is Buffett's bid on a dinner. So Buffett, this is really when he started showing his more philanthropic side, and is, encouraged others to give back, and really showing that he was giving back to different charities and to the community. So the G.O.A.T Foundation is a charity that is based in San Francisco, and its goal really is to help the homeless and people who are struggling with addiction. And Buffett decided back in 2000 that he would have people bid to have a meal with him, and all the proceeds from that auction would go straight to the G.O.A.T Foundation. And so that's still happening today. So every year, the winner of that auction will get a 3-hour lunch with Buffett at Smith & Wollensky in New York City, and that winner will also get to bring along a couple friends to join in on that lunch. So just to give you an idea of how much this has grown, in 2000, the very first winner, Pete Budlong, had won the bid at $25,000. And Chris touched on it earlier, but in 2019, this was the last time the bid took place, a 28-year-old tech entrepreneur by the name of Justin Sun won by placing the highest ever bid at $4.5 million. So we did the math, and the cost of lunch with Buffett has appreciated by 30% on average since the year 2000.
Incredible. All right. And so I'm going to take us through the present to finish this out. So his 70s through current present time. So the first thing you see there is by age 80, he's worth about $60 billion. So the compounding rate kind of slowed down a little bit, partly due to size, but then also partly due to really a big part of that's how charitable he's become over the last couple of decades. And so if we jump into his 70s, a couple of really key things here. So the first major event I'm going to focus on is the Giving Pledge. So in 2006, he made a $37 billion pledge to the Gates Foundation, which was the largest pledge in U.S. history. And then they took it a step further. So in 2010, he, along with Gates, formalized the Giving Pledge, which is meant for the wealthiest individuals to give away a majority of their wealth. And we just looked at the stats. There are currently 216 pledges from 24 different countries, and it represents roughly $600 billion in charitable value. Wow. So truly a huge amount across the board from those 216 individuals. And this really goes, so that's a part of it, and we'll come back to that. But the next item kind of gets into back to part 2 of our series. So if you remember, we made it so that our example never earns more than $100,000 in salary. That was obviously purposely chosen. And so Buffett is one of the most extreme examples of this, obviously. But he shows how compounding for many decades is really the path to wealth, not high income. So he still has never earned more than $100K in salary. And yet, as we're seeing here, he's worth now more than $85 billion. And a key part of that, obviously, is his continued methodology. And so I just wanted to get into a couple of interesting historical examples that he did in the financial crisis as an example of methodology in 2008-09. So really, he has this very famous phrase, be greedy when others are fearful and be fearful when others are greedy. And so over the years, he tends to accumulate capital, but then he's also very careful to keep a healthy amount of reserves to be able to, simple things like paying his employees, paying costs for all the various businesses and subsidiaries that Berkshire owns, et cetera. But then also, it's important that he has that capital to strike and get great deals when there's dives in the market. And so here's basically one of the most interesting deals he got during the height of the crisis. So Buffett stepped in by investing $5 billion into Bank of America, and for that $5 billion, he received that much in preferred stock. So it pays a 6% dividend, or about $400 million in dividends per year alone. But then Buffett, being Buffett, attached a really interesting kicker. And before I explain the kicker, just real quick, this is kind of very Buffett-like. So he's not necessarily always been a traditional investor. He uses all of his knowledge and skills and wisdom he's packed into the years to kind of tweak deals, so he gets custom deals. And so this one had a kicker where he could purchase 700 million shares of B of A for just $7.14 per share. It was obviously less at the time, but he stepped in and was greedy when others were fearful. And so later on, he exercised those in 2017 for a profit of nearly $16 billion off of that $5. So he got $400 million per year in dividends, and then $16 billion just by kind of tweaking that deal a little bit. So just a great example. And there's another quote that says, "When major declines occur, they offer extraordinary opportunities." And so I think this is obviously one of the most maybe more difficult concepts for investors to actually execute on, because there's nothing harder than stepping in, right? But that's kind of the proof of the pudding when you look at it from a long-term results and looking especially at Buffett's lifetime. He's consistently done this, and it's a huge reason why he has high compounded returns despite his mistakes.
Hindsight's always 20/20.
Yeah.
It's very difficult when you're right there at the time. And,
Oh yeah.
Everything's down, and the news says the sky is falling, and you're looking to buy something.
Yeah. Oh yeah. And then obviously plugging in the portfolio construction series that goes in tandem. I mean, that's another reason why we introduce some of these concepts into our investing style here at Apriem. And so getting back to Buffett, so you can see here, kind of towards present day, despite some really large donations that he's made, he's currently worth about $85 billion. And by the way, there's a quick, it's kind of back of the napkin math, but the expected value if he wouldn't have made donations is a net worth somewhere north of $140 billion. So he's certainly given away a lot, but then also missed out on some of the compounding of that too. So let's go ahead and get into his 80s now. And so the first thing I want to point out is that he did finally trade in his flip phone. He's notorious for not being tech savvy or purposely staying outside of it. And he traded in for an iPhone, which is the perfect segue to arguably one of the best investments ever made, depending on how you want to value it, right? But by a couple of key metrics. So for me, this kind of proves that he's still got it. He's still incredibly sharp, especially if you listen to recent interviews, despite being in his 90s. And so really what ended up happening was he purchased Apple shares over like a year and a half period or so up until 2018. And so his cost basis on that is about $35 billion. And now here we are about 2 years later, give or take, a little more than 2 years. And that investment of $35 billion now represents over $127 billion. So if you can judge that based on kind of two categories, why it's considered one of the best investments ever made by a publicly traded company, is because number one, it's got a huge unrealized gain measured by pure dollars over a really short period of time. And so there's a lot of arguments to be made, but so there you go. There's Apple. And in true Buffett fashion, I love how simply he explains some of his past investments. So here's how he describes the Apple one. So in his typical style, he mentions that he takes grandkids and about a dozen or so of their friends to Dairy Queen for treats often. And he noticed that out of all the dozen kids, they really wouldn't give him the time of day, and he could barely get them to look away from their iPhones, without, just by getting them to buy ice cream and things like that. You can kind of just tell that they love it, and their whole world is built around it. So he's really famous for, of course, he's looking at the numbers, but he's adding those qualitative concepts, and that just kind of fits into it. And it's one of his most recent but biggest investments he's ever made. And then just kind of finishing out with a couple of key things. I really like Warren Buffett's take on some estate planning and legacy items. And so just a couple of key things he mentions. The first one, this is an incredibly difficult question, obviously. How much is enough to give to kids? And this is his quote. "I think you should leave your children enough so they can do anything, but not enough so they can do nothing." So I think that's kind of a nice way to say it. There's no perfect answer here, clearly, but it is a great answer, and it can scale kind of accordingly to your wishes. So that's one thing. The next part is him giving away is embedded in his giving away so much of his wealth is really embedded in his ever-present logic. And so he says, I'm leaving a majority of my estate to future philanthropists who can see future needs. I might be able to think outside the box right now, but when the box is 6 feet under, I'm not so sure I'll be able to. So that's his take on the embeddedness of that. So he purposely and also, by the way, he really mentions that he likes to discuss his wishes and does not keep it secret with his heirs. And so he wants to make sure everyone is clear on his vision and trusting his heirs that they can actually carry that out. And then last but certainly not least is his take on education, culture of integrity, and how both of them are so important to him. And so he's carefully chosen generals in his organization to carry out the legacy of Berkshire. Megan already mentioned it, like Ajit Jain, Greg Abel, some of these other ones that are out there. He hasn't made it a completely official yet, but he certainly talks about how he's carefully chosen these people, not just for their competence and expertise, but because they embody integrity. And so last quote here, it takes 20 years to build a reputation and 5 minutes to ruin it. If you think about that, you'll do things differently. I just think that's so powerful, and he's really lived his life that way. And so I think Buffett's a great example, not just of compounding wealth, but how most things in life compound, whether it be fitness or relationships with your spouse or friends. And just, that compound effect on your life is not just about money, but you can build wealth in lots of different areas. And so with that being said, we're going to get into a slight twist on our Q&A. So what we're going to do instead of taking questions, but feel free we can get you back to those if you want to still enter those in the chat. But what we're going to do is we're going to read some of the questions that Buffett has gotten over the years. So Josh is going to be our host, and then we're going to kind of trade off answering those and exactly how Warren Buffett answered them. So it's really Buffett's Q&A.
All right. Well, I hope that everyone enjoyed that as much as I did. It's really fun to kind of go through and hear the history of really the greatest of all time. Cameras?
Coming on.
Hello, everyone. Welcome back. Bye. All right. So first one, I'll throw it out there. And I don't know, do we want to start? Chris, Megan, who wants to take the first one?
I'll take the first one.
Okay, you take the first one. So the question posed to Mr. Buffett was, how would you define true success?
And he said, if you can get to 65 years old or older and have a group of people who truly love you unconditionally, that would define a success. And I know he said a few things that he's known a lot of wealthy people who have museums or, school buildings, and they're very unhappy because they can buy those things, but they can't buy unconditional love.
Great answer. Also spoken by someone who has $85 billion.
I'm sure a lot of people are going to love him once he donates all that, too. What are the best pieces of advice that you would give to people looking to succeed in business?
Okay, so I'm up. So he said first thing is the best investment you can make in is yourself. So, for example, if you invest in being a better communicator, his estimation is that you can increase your value in the marketplace by at least 50%. And then he followed that up in the same reporter and said, if I gave you any car, if I could give you any car, but the catch is that you only get the one car for the rest of your life, how would you treat it? He goes on to say you would keep it clean, oil constantly changed, etc., and just overall very well maintained. And this is analogous to how we only get one mind, one body, and we need to be thoughtful in order to make the most of it.
I always wonder what kind of car I would buy. It's got to be durable. It's got to last a long time. It's got to be big enough to fit all the kids, grandkids. Okay, what about, what is your best general life advice?
So he says to try and constantly look to associate yourself with people who are better than you. And he also added to be careful to choose the right heroes. If you're going to emulate somebody, you better pick very carefully.
Wise.
What is the greatest mistake that people make when investing? Chris, you're up.
He said they think that because you can trade, you should trade.
Ooh.
He said people move around too frequently and don't let the investment thesis play out and give it enough time. The stock market is a no called strikes game. You don't have to swing at everything. You can wait for your pitch. I think it's, I love that one. Especially, I think there's a follow-up to it. He basically says, hurry up and do nothing, right? So, he don't just swing because you're supposed to swing. Just be patient and wait for that pitch. So.
Power of patience.
Yeah.
This is a fun one, Megan. What is your morning routine?
Okay, so I think when Buffett got this question, he was thinking specifically of what he eats for breakfast. So he answered it saying he eats exactly what he likes to eat. McDonald's and other things he liked when he was 6 years old. And his thought process was that by 6, he had found everything he liked, so he stopped there. And he actually added something that we all found pretty hilarious. He said, if you told me I could live 1 year longer by eating things like broccoli, Brussels sprouts, he even included onions, and those types of things, he would say forget the last year because it probably wouldn't be very good anyway.
Okay, here's a controversial one.
Yep.
Is business school worth it?
So he said it depends on the person much more than it depends on the school. Some people are going to get a lot out of advanced education and some will get very little. I don't even think it's important that every person go to college, honestly. We have all kinds of great jobs where you make plenty without needing a degree. I wasn't particularly keen on going to college myself, but my dad basically forced me to. It's a big commitment, and depending on your interest in life, it might not make sense. I will say, though, that it makes sense for most people, but certainly not everyone. I thought it was kind of an interesting take, especially in today's day and age. I think college is starting to change quite a bit, in the midst of a pandemic and online schooling and things like that growing in popularity. So I'm curious to see where this goes.
I think we might be at a precipice where as time goes on, you might see the quality of education go up and costs begin to decline.
That'd be nice.
Yeah, it would be nice. Maybe it's wishful thinking. I don't know. Okay. Do you ever drink water?
He says only under duress, which I assume means he drinks Coke every other time.
I know he has a Coke machine basically next to his office, so he's got a huge fountain of all the Coke products just right there.
All right, here's another fun one. What is your favorite song?
It says "My Way" by Frank Sinatra.
Not to be confused with the one by Usher. Okay, Mr. Buffett, what is your favorite movie?
The Bridge on the River Kwai. It was a film made in 1957 that starred William Holden, and Buffett noted that the ending of the movie is kind of the meaning to life. So it meant a lot to him.
I need to go watch it.
Yeah. Okay. What is your favorite book?
He says The Intelligent Investor by Benjamin Graham. He's actually, I think he's answered this in different ways, but that's the one he gave in the interview we were watching. But that kind of harkens back to what Megan was saying on how impactful Benjamin Graham was on him. And I think really what he's talking about here is basically the emotions of the market make it inefficient. And that was kind of Ben Graham's thing for the most part, was deep fundamental analysis and then taking advantage of those emotions by buying when no one else really wanted to. So
he was also asked his favorite business book by Bill Gates. Asked him, and he told Bill Gates it was Adventures in Business.
There you
go. Okay, what is your favorite TV show, Mr. Buffett?
He says Nebraska college football, but only if they're winning. So not really a TV show. So. Close enough.
All right, and this is a pretty fun one. So, what do you carry in your wallet, and how much money do you carry around?
So he said, well, I probably carry about $400 cash on average, but I definitely carry an American Express card I got in 1964. So, and then American Express is about $400. That's what you get with Buffett in his wallet.
All right, so that essentially is all of our questions there. I think I have one final question for the both of you. Fantastic series. Thank you guys so much for putting all this together. Why did you choose to end the series in covering Warren Buffett?
You want to go first, Megan?
Yeah, I'll go. I think one of the reasons was he's done so many incredible things, obviously, throughout his life. But I know one of the big takeaways I got from highlighting him was the fact that he never made an excessive amount of money as far as salary is concerned, and he also continued his simple lifestyle. So I guess if there wasn't so much coverage of him, we wouldn't know, how much money he made and how hard he's been working to attain that goal for himself, which is really inspiring.
For me, So I grew up in Bakersfield, for those that don't know that you're watching. And so, him growing up in Nebraska, farmer, that kind of an area, not a whole lot of wealth per se. He's always been like a magnet to me, and was very inspiring even from a young age, just kind of reading about his life. Because for me, it was cool to see someone who, he didn't really have an original idea, right? It wasn't like he was some big inventor of the next biggest thing. All he did, but he did it very well. He only did a few things, right? He was very efficient with capital, always tax efficient, and then he just had the best temperament you can have with the markets, which is just trying to be as logical as possible. And so I just thought it was so cool, growing up. I still think it's amazing that he was able to do what he did without inventing anything. He was just using the rules of capitalism and compounding math for many, many decades, and he's able to create all this wealth. And he employs hundreds of thousands of people if you think about it too. And there's a lot of benefits there. And he's able to donate. He's been one of the most generous people in history in terms of how much money he's been able to donate and all the good he's done. So yeah, that's my answer.
Fantastic. I like when he says, you should surround yourself by people that are better than you.
Yeah.
Right. And if you're going to be investing, granted, maybe you can't be directly around Warren Buffett, but there's so much content available out there about Warren Buffett, who he is, that you can read and you can listen to and you can watch. That he exudes so many characteristics that I think that any great investor should want to emulate. So it's a great place to put your education and your talents. I think it's a great note to end on. Yeah. With that, I want to again thank everybody for joining us. Please don't forget to fill out your surveys. Also, feel free to submit to us any thoughts. What would you like to hear? We're looking to put together another, more great series moving forward. So if there's specific education or things that you guys are interested in that you want to know about, please share that with us, and we're happy to begin to take that into consideration. So thank you so much.